If you look at markets at this point in time, we've seen quite a bit of turbulence. But then again, this is not the first time which is happening. The story has played out before as well.
I think over the last 2.5 decades, what I've realized is that the only certainty in our business is the uncertainty. There is a risk element, when you're investing your money. If you really want to create a lot of wealth in equities, and for the risk what you take, over time, market gives you the payout. Then there are certain do's and don'ts.
Sure.
And the sooner you learn the art of investing in equities, the journey will be very, very smooth.
These are the stories that, probably our, fathers or grandfathers used to tell us that, what they experienced during that, World War II times. Food is already on boil. Rupee has hit record lows. I'm sure you must be getting a lot of queries at your end as well. How are you tackling that?
These are challenging times. Over the last 12 months, if you see back to back, there have been various challenges. Largely for a very long time it was looming over the tariffs and how things will evolve between India and US. In between, the good news was that we could do several other free trade agreements, which is going to be very positive for Indian economy in long term.
Hello and welcome to another podcast. Well, my name is Kshitij Anand, and today we'll be talking about the principles of quality investing. Well, if you look at markets at this point in time, there's a lot of turbulence, there's a lot of uncertainty, but this is not the first time that we are seeing this kind of scenario. It has played out before, but then what should investors do at this point in time? What are the things that investors should not do, and what are the things that one should keep in mind? And to discuss this and more, we have Akhil Chaturvedi, who is a Chief Business Officer at Motilal Oswal AMC. Akhil, welcome to the podcast.
Thank you, Kshitij.
Thank you so much for taking the time out. And Akhil, well, you have decades of experience under your belt, and you've seen these scenarios before as well. Especially from an investor and a business standpoint, how do you see things evolving at your front as well?
So, Kshitij, I think over the last 2.5 decades, what I've realized is that the only certainty in our business is the uncertainty. So it's a business of uncertainties. There is a risk element, when you're investing your money. And for the risk what you take, over time, market gives you the payout, or it gives you the dividend.
Right.
So if you really want to create a lot of wealth in equities, then there are certain do's and don'ts.
Sure.
And the sooner you learn the art of investing in equities, the journey will be very, very smooth.
Right.
In tough times, it will pain you less, and in long term, you will be rewarded beyond your imagination.
Right.
So it's happened in the past, like you rightly said, and it will continue to happen in the future. There will be new challenges, new situations.
Sure.
For example, Kshitij, COVID came from nowhere.
Right.
I don't think ever in my life I would have thought that there would be a pandemic
Scenario like this,
where the entire world kind of shuts down.
Right.
And you're sitting at home and you have no idea what's going to happen, right?
Sure.
So we have seen that also. So I think what we are seeing today is 1% of what we saw in 2020.
Absolutely. And interesting times back then and interesting times now as well. And for most of the new investors, I think this is the first time scenario that they must be going through. And these are the stories that, probably our, fathers or grandfathers used to tell us that, what they experienced during that, World War II times, or you
Yes.
could say that. And I'm not saying that we are in that phase, but then again, if the situation escalate to few more countries, then yes, there could be some volatility with respect to equity markets. Crude is already on boil. Rupee has hit record lows. I'm sure you must be getting a lot of queries at your end as well. How are you tackling that? I'm sure interesting times for you as well on the business front.
No, certainly, I think it's these are challenging times.
Sure.
And it's not that these situations are arising today. I mean, today we are talking about the fresh conflict, which is between Iran and US stroke Israel.
Right. Yeah.
So that's the latest conflict. And just as we thought, that the tariff related issues are behind us,
Sure.
and everything is looking good.
Right.
This is something which comes up. And so over the last 12 months, if you see back to back, there have been various challenges. Largely for a very long time it was looming over the tariffs and how things will evolve
Right.
between India and US.
Yeah.
In between, the good news was that we could do several other free trade agreements, which is going to be very positive for Indian economy in long term.
Sure.
Fortunately, in the month of Feb, we got a broad agreement between us and US.
Right.
But now with this fresh conflict, and it's a serious conflict,
Yeah.
so
Yeah.
it's not an easy one. Certainly impacts all of us. It impacts the entire world, except for US, I think so. So especially for the eastern part of the world, which are greatly dependent on oil and gas imports. With this conflict, there could be impact on our macroeconomics. So one can only hope that this kind of settles down
Sure.
sooner than later.
Right.
But yes, I think, like I told you that these kind of situations will emerge. And over the last couple of years, people like us, you, me, media, generally we were kind
Right.
of always thinking that investors over the last 5 years generally have had a very good experience.
Sure.
And the kind of returns one has made over the in the period 2021 to 2024 were outlier.
Yes. Yes.
And nobody had any bad experience as
Right.
such. We were worried that when this kind of a situation happens, when the markets are not giving returns
Right.
on a 12-month basis, or people are not making money, then how the reaction would be. Now the good news so far is that we are seeing a lot of maturity in investors.
Sure.
Yes, the flows have slowed down, but it has not evaporated.
Right.
If you see the industry flows, they continue to be positive by about $4 billion every month.
Right.
The SIP book continues to grow, and it's now at about 31,000 crores.
31,000. Yes.
So I think there is a worry amongst investors, but they are not kind of panicking in this kind of a situation.
Right.
In fact, we are seeing many investors are actually adding more to their SIPs or trying to invest into liquid funds and then doing a systematic transfer
Yes.
plan. But
Right.
I'm not seeing investors run away. So the maturity level certainly has changed, and it's all thanks to all the awareness which has happened over the last couple of years.
Right. Right.
The worry could be that if this kind of a no return period or a low return period continues for a few more months ahead,
Right.
then how the reaction would be. That
Yes.
if you're not making money for last 1 year, understandable.
Yes.
If this spills over to 2 years and 3 years, then in the past we've experienced people have lost patience. They move out of the asset class.
Yes.
So I hope that what maturity we have seen so far should continue, but it's still, I would say, a wait and watch kind of a situation in terms of how the investor behavior will kind of reflect over time.
Absolutely. Good that you brought this point of SIPs. And yes, we are seeing consistent flows of more than 30,000 odd crores at this point in time. But around the same time, the other thing which usually gets confused, or how investors get confused, is to how to differentiate between where to put the money. Is it the the flexi cap, or is it the large cap or the mid cap funds that should be go? And Motilal has been largely into the growth investing part of it. So especially at this point in time, any scheme which is not doing well, over the past we've seen this, that people tend to move their money out from that particular theme to a different theme altogether. Is that right? And how should one be looking at it? It's a more balanced approach, or focus on the growth investing part of it?
So I would say that for young investors, new investors, the strategy should be to come into diversified funds which are more flexi cap, multi cap in nature, because these investors don't have enough experience to time large cap, mid cap, small cap, which basket to enter when and when to exit, all of those things. These are more for evolved investors who can try and do some kind of a timing. So for newer investors, I would suggest that always flexi cap or a multi cap kind of a product. In fact, even I like the large and mid cap category. So these three categories of funds are very good categories to invest. Make it as your core portfolio. 60-70% of your money should be in diversified funds across market cap buckets, because then you don't have to chase large cap, mid cap, small cap. At any given point of time, you will get participation into some or the other basket which will be outperforming each other, right? So if you want to have a peaceful night of sleep, then go for these kind of funds.
Yes.
For the evolved investors, of course, they understand this better, but we talk about this theory of winners rotate. So within markets also, there will be cycles of or phases when the large caps do very well. For
Sure.
example, last 12 months, large caps have done better than mid caps and small caps.
Right. Right.
But when there is a lot of optimism, euphoria, everything is doing very good. The economy does very well. The markets are very good. All the news headlines are all positive. These are the times mid caps and small caps do very well.
Do well.
Now, the ideal investment approach should be counter-cyclical.
Mm.
So, in a phase when large caps are outperforming mid caps and small caps, then actually one should look at the basket which is actually underperforming.
Okay.
Because then you are getting that basket at a lower valuation.
Yes.
So, for instance, if you tell me that where will I put my capital more today, I'll probably choose mid cap or small cap because that has underperformed over the last 12 months or 18 months. The returns have been suboptimal. The PE multiples have corrected. So valuations are looking far more attractive. We are seeing the earnings growth coming back. So one approach is that I look at the past return. That will push me into large cap.
Sure.
One approach is I try to look at what is going to happen in the future. Then I will look at mid cap and small cap. So buy those spaces where you get value, where you get margin of safety, and these will be the spaces generally where the past return will be very, very low, right? So that would be my suggestion for the newer investors, younger investors. Go for a blended approach. And for the evolved investors, of course, I think a counter-cyclical approach can really help you get that extra alpha to your portfolio.
Absolutely. Also, one of the pillars for Motilal has been the QGLP approach. If you can help us, demystify what it actually means and how it helps in decision making, we'll definitely come to the part as to how you pick stocks based on this approach. In the next question. But first, QGLP.
Yeah. So QGLP are basically proprietary frameworks.
Sure.
Which actually got innovated or authored by our chairman, Mr. Raamdeo Agrawal. With his 40 years of experience in investing in equities, he has also evolved in terms of his thought process and his philosophy and how he looks at identifying good businesses.
Right.
And that's how I think slightly over 10 years QGLP took birth. Now, what QGLP basically means is Q is quality of business and quality of management. G is for growth of business. L is for longevity of both quality of business as well as growth of business. And finally, P is the price part. Now, there are about 5,000 plus companies listed in the market. And if you have to create a portfolio of 30-40 companies, then how do you filter down to creating a universe of 200-300 businesses out of which you choose 20-30 companies where you want to really put your money? These frameworks come very, very handy. So as I told you, quality, growth, longevity, price, all these 5,000 listed companies are actually filtered in the same funnel and in the same order. So the first check which goes is the quality check. Because we are investing into a riskier asset class. We are investing in equities. Prices go up, prices go down. There is always a greater chance of losing 100% capital. So if you have to protect your downside risk, then you have to focus a lot more on quality. And in fact, quality, for anything you do, you will look at quality. Even if you want to buy clothes, you will buy quality clothes. Everything you do is all about quality. So essentially what we look into the quality framework is typically the competitive advantages in the businesses, right? Because we want to buy leadership companies. We want to buy companies which have very strong competitive advantage. They are category leaders, enjoy good brand, good customer feedback. So those are some of the qualitative aspects when you look at a business. And then obviously you need the business to be run by a very strong, very ethical, high on integrity management, right? Because most of the time what we have seen is that the businesses don't fail. It's the management which leads the business to fail.
Sure.
So even if you want to invest in a tough sector, for example, airlines, it's a very tough sector, very difficult to make money. But within that, you have in US a Southwest airline which is very successful, or in India we have Indigo, which is very, very successful, right? So a lot depends on the quality of management, right? The financial parameter what we try and look at when we look at quality of business is the return on capital. Typically, as Buffett says, that there are great businesses, there are good businesses, and there are gruesome businesses.
Yeah.
And how he has explained this is that businesses where the return on capital is higher than cost of capital, these are considered as great businesses. Businesses where cost of capital is equal to return of capital, these are good businesses.
Sure.
But where your return on capital is below the cost of capital, these are the businesses which are gruesome and you stay away from.
Exactly.
Right. Fortunately, in India, over time, what we have seen is that the quality orientation of the index itself has become very, very good, right? So you're getting 14-15% ROE even in the index companies, right? But yeah, I mean, typically, if you have to look at the financial parameter, then you look at return on capital or return on capital employed.
Right.
And a combination of this gives us a good check on the quality side of the business. And you'll be amazed that 90% of the listed businesses are actually filtered out in the quality framework itself.
Okay.
Right. So then
90%,
you're left with
that's a big number.
90%. So you're left with 500 to 600 odd companies.
Right.
Now, once that is created, then we look at which businesses are growing at what pace.
At what pace,
right?
yes.
So you can buy the bestest of the best blue chip companies. For example, in the FMCG segment, best businesses, best brands, 100-year-old plus brands. But they will grow at 10-12% snail's pace, right? Because these are gigantic companies now.
Yes.
Right. So now, but if you want to make 15-20% return, then you have to hunt for businesses where there is growth which is equal to 15%, 18%,
Sure.
20%, or let's say a couple of basis points higher than the index growth itself, right? So that growth is nothing but the earnings growth or growth measured by profit after tax, right?
Yeah.
So at the end of the day, what market rewards is earnings, right? As they say that markets are slaves of earnings. Earnings is nothing but profits,
Right.
and good investors will always try to balance a mix between quality and high growth companies, which is where we position ourselves. So if you see some of our presentations and some of our marketing material, we talk about high quality, high growth, best of both. That is what we are trying to do.
Exactly.
The third element is longevity. So we're looking at visibility of growth as well as quality for the next 3 to 5 years, because we are long-term investors. You look at 3 years, 5 years, can you visualize that everything will remain as you are predicting it to to be, right? And then finally, when you have done the quality check, you've got your growth check done, you have seen the longevity, what is the price you want to pay for that quality and that growth?
Sure.
It actually goes in this kind of
Another
order.
filter, another
so
funnel.
Quality, growth. So like I said, 90% out in quality framework.
Sure.
Maybe another 10-15% out on the growth framework, then longevity, and then finally at valuations. And that is how we come to, so we have an active universe of about 250 companies, and within that universe of 250 companies, we have different portfolio managers. They choose companies where it fits in their thought process. Right. But yeah, that is in brief, in a very simplistic way, what QGLP means. But when the managers and the analyst kind of put a proposal for getting some new business included in the investment universe, on the same parameter, there are long reports which are written explaining quality, explaining growth, explaining valuation, so on and so forth. And then there is an investment committee, and then within which is decided whether stocks have to be part of the QGLP universe or they have to be out of the QGLP universe. But it's I would say it is I keep saying this, that it's a Brahmastra of investing in equities, right? Even if you are an individual investor, you can apply these frameworks and it will help you create a direct equity portfolio. But think about it that, I mean, if a quality of business comes down, let's say the management is not good or the business is not doing good, will you invest in it?
Yes.
So on the same parameters, the stocks are also exited. If the growth falls down, you have to think about exiting. If the price goes up, valuation is expensive. So in the same order we buy, the same order we also exit them. Yeah. So it's very, very simple and easy to execute.
Absolutely. Well, I'm sure it's easy to execute, but a lot of investors would want to understand is, there's this one word that keeps repeating, and that's growth investing. So, if you can also help break down what growth investing actually means when we are saying growth investing, what are the things that we are looking at? A couple of things that you've already mentioned: the ROA, return on asset, and the return on equity, principal return on capital employed. So, is that a part of the process?
So growth, when we talk about growth, before we talk about growth, one has to understand that largely when it comes to equity investing, there are largely two kinds of investors. There are value biased investors,
Okay.
and there are growth biased investors.
Sure.
Right now, value biased investors are typically trying to buy companies which are cheap, which are very attractively valued, or the PE multiples are very very low,
Right.
and also suggesting a higher intrinsic value for the investors. Right.
Right.
So the value investors typically will focus on quality and valuation, or
Okay.
quality and price. Right. So that's one set of investors, and in market there are cycles when value does well and then growth does well.
Right. It's
Like we
interchanging.
spoke some time back, in tough times, in challenging environment, typically value will give you the protection, or
Exactly.
or when the markets are recovering from the lows to the next bull market, the first recovery happens in the value stocks. The low PE multiple stocks go up first. Right. So that is a relevant style. It's something which is often spoken about when you talk about Benjamin Graham, because he was the father of value investing,
Value
and
investing,
then
yes.
practiced by Warren Buffett.
Right.
Now we are in India. Right. So in India, it's an emerging market. We are a growing country. We have new businesses. India is a growth market. Right. So, in India, if you really have to make money, then you have to have a growth orientation.
Yes.
What growth investors do, of course, is focus on quality.
Right.
Valuations, of course, are important, but a greater focus is given on growth.
Okay.
So, quality and growth is for the growth investors, quality and price is for the value investors.
Okay.
Now, like I explained to you, growth is nothing but growth in profits.
Sure.
Right. Now, let's say over the last 5-year period, the top 50 companies of India, Nifty 50 companies, have delivered a 16% profit growth. That is the top 50 companies of India. Right. Now, if you want to create a portfolio with, let's say, 20% growth, right, then you have to hunt for ideas outside the Nifty 50, right, and then create a portfolio which is different than the index, but it offers you a higher growth element.
Similar.
Because eventually, in long term, what we have seen is that growth is equal to return. You will make as much money as the businesses make. And in country like ours, you have all kind of companies available. There are companies which are growing at 10-12%. Like I spoke, some of the multinational companies, old companies, blue chips, these are big companies, so they grow at a slower rate, right? But so much of innovation, so much of new entrepreneurship, new business models. There are so many businesses which over the last 5 years have been growing at 30-40%. Right? So you have all kind of companies available. Depending on what your return target is, you have to do the effort to hunt for those kind of companies which can give you the kind of return you're trying to make from those businesses. Right. So net in simple terms, it is basically trying to figure out that within which industry, which are the top 2-3 businesses, who are the disruptors, where are the competitive edges, and which business in a particular sector or a theme will do maybe 5%, 10% higher growth than the base growth of the sector itself. Right. So yeah, that's essentially growth investing. Growth typically, unlike value, doesn't come very cheap, because the companies are growing very very fast. So the PE multiples of high growth companies tend to be far superior than the value oriented companies. And therefore you have to, when you try and look at valuations as a growth investor, you have to look at the growth and the price earning multiple in connection with each other to understand whether the company is expensive or cheap. Because for most investors, price earning multiple is a very simple way of just kind of saying that this is expensive, this is cheap. Right. Anything which is 15-20 P multiple looks good, 10-12 P multiple is cheap, and 30-40-50 P multiple is very expensive. Now you just put the growth angle. So if you correlate price earning
You're right.
to growth, then everything starts looking very different. Just to give you one last example on this, so then it kind of completes the loop. Let's say you are successful in identifying a company which has the potential to deliver a 30% growth.
Okay.
And it is available at 30 P multiple. Now, if you look at P multiple in isolation, it may look expensive.
It may look expensive.
But if you divide price earning multiple by growth, you will get 1, which is PEG. So the price earning to growth ratio is a good ratio, which most of the time the growth investor will use to assess whether they are buying expensive stocks or cheap stocks, right? So in theory, any company which is valued at a PEG of closer to 1 will be fairly valued. Lower than 1 are very attractively valued.
Yes.
And the higher you keep going, so beyond 2, 2.5, 3, 4 is where you are going in that dangerous zone of valuations, right? So these are some thoughts on growth versus value.
No, absolutely, and valid thoughts there, and I'm sure our investors would take note of that. But we are also in interesting times, Akhil, and a lot of our large cap stocks are now available at very attractive valuations because of the recent drop that we have seen. Most of them, I'll not say that not all of them, but most of them are trading below the 200-day moving average or the long-term moving averages. If someone does track that, I'm trying to put that language in the podcast, which I'm sure most investors use, so that they can understand where we are coming from. So yes, from that point of view as well, the price has now become quite attractive for both large cap, mid and small cap stocks. So I'm sure these are interesting times for you to put money in these fabulous names which are now available at cheaper valuations. And a similar approach which I'm sure a lot of investors should also take note of, and they should not get scared of why I bought that stock at X price and now it is available, now it is trading at X minus Y, you could say that.
No, you're absolutely right. But so if I have to add to your point, what you're saying is absolutely making sense. But what has happened in the last 12 months, if you see, is that the winning sectors have rotated. So those sectors which gave phenomenal returns over the last 3 years are the sectors which have got corrected, or there has been profit booking in those spaces. I'll explain more. And there has been a rotation in the winning sectors. So for example, what you will see, just see over the last 12 months and just take the indices, returns of variety of indices, right? Now you look at the winning sector, the highest returns which has come from the defense, which is 50. So the defense index has done a 55% return. Right? If you look at metal index, which was underperformer between 21 and 24, has been another index which has given 45% return. Right? Today also it is up 3-4% because there is a commodity rally which is going on. The public sector banks, phenomenal returns, 35-40%. I'm just talking about indices right now. Banking index, largely it has underperformed between the 21-24 phase. It has outperformed. So the phases which underperformed between 21 and 24 have done phenomenally well in the last 12 months. And what has not done well is some parts of consumer discretionary which were outperforming, or some parts of capital market theme, NBFCs, power. So the sectors which created a lot of wealth over the last 3 years have actually underperformed in last 12 months. And those which underperformed in the last 3 years have outperformed in the last 12 months. So, and also, therefore, there has been a style rotation in the last 12 months. So the growth style investors are underperforming. And the value style investors are actually
they've started to
outperforming, right? So like I told you, that counter-cyclical approach is extremely important. So if value is doing well, and if you are fortunate to come into value at a right time, then you are decently in money, right? And as it starts to keep going up, somewhere it will peak out, then you have to move towards growth. Right? So growth today is, according to me, growth today looks far more attractive than value, simply because the value spaces in our market has done extremely well. So on a lighter note, growth looks like value, and value is looking like growth in terms of valuations. So just I thought just to add to your point
No,
in
no,
terms of
absolutely,
large caps,
absolutely.
mid caps.
Perfect. Another thing, I wanted to sort of get your perspective on the quality part of it.
Yeah.
And, because the QGLP approach starts with quality.
Yes.
And I was actually speaking to some of the fund managers, and interesting point they raised. I'm sure if you want to add, your point to it or not, is that especially with the homegrown companies that we are seeing,
Yeah.
lot of the new generation either does not want to join the business, or either they just want to stay away and probably start something of the, they don't want to do the continuity
Old
of
business
the business,
or
that
legacy. Yeah.
of the legacy business, you could say that. Does that also raise a red flag, a kind of a thing? Or if they've employed a professional CEO, or they've been trying to do that, but for some reason it has not come into the picture because they're sharing the reports, we are planning to appoint a CI or a CEO, but it hasn't come.
Yeah.
Wanted to get your thoughts on that as well.
No, completely agree with you. So, as investors, we are always looking at, like I said, there's a lot of emphasis on the management, on the promoters. And if you are looking at a business where the promoters are senior, or they are, way above their retirement age, or,
Right, right.
then obviously you're looking at the succession planning of such businesses.
Sure.
Whether there are two ways one could go in such businesses. One is that you have your children who come in and they take the legacy forward.
Yeah, yeah.
The other approach what we have seen is that a lot of these promoters, successful promoters, have created a professional structure
Right.
where the promoters behave like promoters, so they are shareholders, they are like the board. And then there is a professional team,
Right.
professional CEO, professional board, and all the critical functions are led
Yeah,
by
yeah, exactly.
professionals. And
Right.
in a lot of cases, we have also seen that these professionals who are probably at the CXO level are also given a lot of skin in the game, which is ESOPs and stocks, such that their behavior is also aligned with the behavior of promoter. So when we are looking at businesses, we are looking at this aspect. We are looking at the succession planning,
Sure.
how the legacy will continue.
Right.
If children come in, whether they will try to change the business model. And
Ah.
so there are many things. There is no clear-cut answer to this, but you have to see it's like
This
case
is
by
also,
case.
also an evolving situation, not
It's an evolving situation.
because initially I think the first step usually is that somebody from the family would definitely take it up.
Yes.
But then again, now things are changing, and as you rightly pointed out, we are in interesting times, and this is another part of the story that we are facing through. I'm sure when you're picking the company, these are certain decisions.
100%.
These
100%. There are many things which are, it's not, we are looking at a lot of things. We have analysts who are traveling all around the country, visiting plants, visiting sites. We talk to customers of these businesses which we like. We talk to ex-employees. In some cases, we've also done forensic checks.
Right.
I can give you a laundry list of things, because just to be very sure on the quality aspect.
Yeah.
Because if once this quality thing is sorted out, at least I can tell you in my experience, let's say over the last decade or so at MO, more than a decade, that 2 or 3 mistakes which have happened in investing largely has been on quality of management. It's not been too much to do from business perspective or growth perspective or valuation perspective. But 2 or 3 disappointments we've seen is largely from quality of management perspective.
Right.
So it's very easy. It's still very easy to understand quality of business.
Sure.
It is still very easy to understand growth, valuation, all those things. But management and what is going on in the minds of the people who run the show,
right.
there is where you need a lot of experience. So thankfully we have Raamdeo Agrawal with us, or we have Pratik Agarwal with us, and very senior people who have met with hundreds and hundreds of promoters, businesses. So with their 3-4 decades of experience, the error of commission can be brought down to a great extent. So like I said, we would have bought 400-500 stocks in the last 10 years or so. Mistakes has been 2 or 3, so that's 0.0001%. But for those of your viewers who are in active equity, direct equity, please think about this aspect.
Absolutely rightly said. So, also, let me get your perspective on, you know, on how one should now be picking stocks. Now, let's talk about the wealth generation part of
Yeah.
it. More interesting themes, from a long-term perspective. We've already talked about value. Already talked about the
Yeah.
growth investing. So, another question which I'm sure a lot of investors have in their mind: will growth work or the value works?
Yeah.
Over a period of time, let's say in a long term 5 to 10 year kind of a scenario, because yes, we know that the alpha generation happens in growth
Yeah.
more
Yeah.
so
Yeah.
than value.
No, so see, I think let me explain to this in different ways.
Sure.
See, one, you should have your end goal in mind,
Hmm.
right? Now, if your end goal for a aam aadmi, so to say, for a average retail investor like you and me,
Yeah,
we want to ensure that after 5 years, we want to buy, let's say, our home.
Hmm.
After 10, 15 years, we need money for our children and
Yeah,
their
yeah.
education.
Yeah.
These are big costs.
Big cost, yes.
And then after that, we need for their marriages. And then after that, we need for our retirement. These are the four large goals which any person who's getting into the workforce has
Yeah.
ahead 30, 40
Right,
years.
right.
Right? And when you have those goals, you have to put your earnings to work in a nice way,
Hmm.
such that you can create a passive income which can help you achieve such goals over 5, 10, 20, 30 years. For that, asset allocation is very, very important. For long term goals, you have to put higher allocation to equities, right? And for your short term goals, you need to have a balanced approach between fixed income and
Yes.
equities. Now, always keep this in mind, that we are investing for our medium term, long term goals, for which we decided that X percentage will be invested in equities,
Right,
right? And till such time those goals are not achieved, we have to remain invested in equities, right? So that will, kind of train your mind to start thinking long term. First, we have to start thinking long term,
Long
right?
term, yes.
So when you have put an emotional angle, you will start looking at your investments from the emotion perspective,
Yes.
not from a return perspective, right? Now, why I'm telling you this is that every now and then markets go up, markets go down. We are thinking about returns. We are thinking about what has happened in last 1-2 year, what will happen in next 1-2 year.
Yeah.
The purpose is not that.
Yeah.
The purpose is that I need money after 10 years. I need money after 20 years. Then I have decided to put, let's say, 50% in equities. Every time I have money, I get my salary, I have to put 50% in equity and keep doing that for till the time your goal is achieved, right? If that kind of a conditioning can be done to the mind, one will not be worried about the short-term swings in the market.
Right.
One will be aligned to continue with the investments across all points of times. One will stop doing this timing of the market business, right? And we all know that once you have spent 7 years and beyond, then the probability of losing money in equities nearly comes down to zero.
Right.
And after that, I mean, you won't even ask this question. I mean, it doesn't happen, right?
Yeah, yeah.
So the whole worry is that initial 5-7 years which you have to spend, in which you will see all your portfolio fluctuation. So I would say for a investor, long-term investor who wants to create wealth, who wants to achieve goals, who wants to have a higher purchasing power in future, has no other choice but to invest a meaningful portion in equities with a long-term mindset.
Absolutely.
You can, within equities, you can swap between one stock to other stock, one fund to other fund. All that stuff is fine, but you have to remain invested in equities. Now, like we spoke initially, that there are rules of the game. There are do's and don'ts. Now, the biggest rule of the game is in equities is that be greedy when others are fearful and be fearful when others are greedy. Which means nothing but be excited when the markets are down and be a buyer in that market, right? And be fearful when the markets are up, and maybe you can moderate your exposure towards equities then, if at all you are kind of, but certainly be a big buyer when the markets are down. Markets are down meaning good companies are available at a lower price, lower valuation. It will help you get that additional return over a longer term period, right? So whenever I go through these phases, and I'm a retail investor myself, and I've started from zero, and I'm in a comfortable position today, thankfully, but I have paid, like Raamdeo ji says that you have to pay tuition fees. So I have stuck to my investment discipline between 2009 and 2013 post Lehman crisis, where for the 5 or 6 year period there was absolutely no money
No
which
money.
was being made,
Right.
and every SIP which I was doing, the portfolio was going down by that much amount subsequent month, right? But today all that thing in hindsight looks like a great what a great investment in my investing journey, right?
Yes, absolutely.
So from that, the learning is like today I'm very excited if the markets are down. I know this is a war, nothing to do with India.
Sure.
There is a tariff, short-term impact, long-term gain. So everything has a short-term impact and there are long-term impact. So
Right.
broadly, if you're confident that long-term India looks good, then remain in India.
Yeah.
Thankfully now, Kshitij, when you talk about asset allocation, today's investors has so many opportunities available,
Absolutely.
right? This was not available 20 years back or 15 years back. You can invest outside of India, diversify your equity portfolio from apart from India,
Right.
go into developed markets, go into emerging markets, de-risk your portfolio and benefit from growth of China, Korea, Brazil, US, Europe, which wherever you feel you feel opportunities there. Today you have commodity funds, gold, silver. They have done well in the recent past. Have a strategic allocation towards commodities. Have a strategic allocation towards international equities. Have a allocation towards Indian equities.
Sure.
And then fixed income, of course, you have tons of choices. For rich investors, you have alternate portfolios. You have unlisted. You have all these venture capital funds. You have real estate. So the choices have become phenomenal, and you have passive funds. I mean, कुछ नहीं समझ में आते तो just buy the index.
Exactly.
At least the index itself is doing very well. तो कुछ नहीं समझ में आया, buy a Nifty 500 or buy a mid cap 150 index or whatever it may be. So there are a lot of choices available.
Right.
Net to conclude to your point, just make a nice asset allocation plan. Stick to your asset allocation plan till you have achieved all your goals. This will help you to a large extent to not be fearful in bad times, but actually be excited. I can tell you, I don't know whether I should say here or not, but I have some options, right? So, so I had, so there was some options available for vesting. Right. Okay. And yesterday the prices came down. So honestly, I was excited because I thought that if I buy at lower, if I exercise my option at lower price, I'll have to pay lower tax.
Right.
In long run, I know this firm is going to do phenomenally well, but why not take the advantage of lower prices to save on taxes? So actually the prices were going down. Honestly, the behavior should say that you have to be panicking and you have to be sad, and other thing is that you have become greedy, and you're saying, okay, let us exercise, right? So actually end of the day, I ended up investing yesterday.
Okay.
And yesterday was the day when it was the first day India opened after the war.
Sure.
Right.
Sure.
So like that, it's just about conditioning your mind. Investing in equities is all about behavior. Yes. It is all about conditioning your mind,
more mental strength,
managing your emotions, and if you can do that now, for that you have to stop monitoring your portfolio every day. Recently, I'll tell you one more funny example. I was traveling from Surat to Bombay. You take a train. There's no flight available.
Right.
So I was in this compartment, and evening time, I think 1 out of 3 phones in that coach, people were, and Gujaratis.
Exactly.
So they were all, sabka money control chalu tha. And I could see everybody is going up and down and seeing what is, mostly sabke portfolio ready dikh rahe the. Right. Piche se to. So I think रोज देखने से तो कुछ पैसे बनते नहीं है.
Exactly.
Right. तो just मतलब buy right, sit tight, वो philosophy है, वो follow करो.
Absolutely. And we are in that phase where actually markets have shown a slight bit of dip initially, and there's one line or one quote that I would like to share here. You talked about global investing, na? So it says one of the fund managers said that let your money travel the world.
Yeah, absolutely. So, I'm doing that for myself.
Yes, absolutely.
In the last 3 years, I have moved a meaningful portion of my portfolio into outside of India.
Outside India,
yes.
Yeah. So yes, so interesting one. But let's come back to portfolios, Akhil. And I mean, Motilal Oswal has been, especially they're very diligently making the focus portfolios.
Yes.
How does that help in diversifying the overall exposure? If you can
Yeah.
also explain that.
So again, Kshitij, there is no right way, wrong way,
Sure.
right? Different people have different ways of investing and creating portfolios. We spoke about style, value, growth.
Yeah, yeah.
Now it comes to how many stocks you want to own.
And I'm sure everyone would have their own view. So
Yes,
you कहता है नहीं यार
absolutely.
20 ठीक है 20 से ज़्यादा नहीं होने
Absolutely.
चाहिए नहीं 30 होने
Absolutely.
चाहिए 10 ही होने चाहिए.
Absolutely, absolutely. So everybody has their own ways of thinking, but let's say in a professional asset management industry,
Mhm.
you will have portfolio managers who have 100 plus stocks in the portfolio, and they also do well.
Right.
And then you have portfolio managers which have more like 50 to 70 stocks in the portfolio. They also do well.
Right.
And we are as MO Motilal Oswal. Uh, our philosophy is more like 30-35 stocks in a portfolio. The underlying thesis is that if you have to outperform the market meaningfully,
Right.
or if you want your outperformance to be outsized, then you need to have focus portfolios. You cannot, the more stocks you will add in your portfolio will take your portfolio closer and closer towards the benchmark.
Right.
And as your portfolio size goes closer to the benchmark, your return profile also will move closer to the benchmark
Towards
returns.
the benchmark.
Right. So our only argument is that if you want benchmark returns, then buy the benchmark.
Okay.
Then why you pay fees and all that stuff. But if you want to buy portfolios which are different than benchmark, then you should come to people like us, where we are very, very different. Our active ratio will be like 70-80%.
Right.
So we are trying to create meaningful alpha, for which one we are trying to have portfolios which are different than the benchmark. Also, we are trying to have focused portfolios with meaningful allocations in each and every high conviction idea that we like.
Okay.
Right. If I like X idea, and I have full conviction in this idea that it's a great thought, and the idea looks good, the business looks good, and then I end up buying 0.5%, and that idea becomes 3 times. Then what is the alpha in the portfolio? So we do manage within 30-35 stocks. We do prudent risk management. We try to keep flat portfolios. We don't over allocate to any stock. We don't under allocate to any stock. Both are very, very important.
Absolutely. Part of the risk management process.
So our belief is that focus portfolios tend to, in long term, tend to do better alpha than portfolios which are very large in terms of number of stocks. And maybe that is our competitive advantage. Yes, the negative of this way of creating portfolios is that in bear markets or in a corrective markets, you may correct slightly higher. Right. But in good markets, in bull markets, you will also do. So eventually, after you go through the good and the bad, what is the alpha that you have generated is very, very important.
Exactly.
Right. So this is our thought.
Right.
As I said, everything is right. There's no right or wrong. So we have our own thoughts. Somebody else will have, and over time we have seen everybody is delivered.
Yeah, absolutely. Also, tell us again, any new launches lined up right now for you?
We have several plans, honestly.
Okay.
We will wait for the right time. I think these times are not the right times for doing new ideas.
Okay.
In mutual funds, broadly on the active side, we have completed our basket of all the products which possibly we can do. Recently, SEBI came out with a circular suggesting a new category, which is the life cycle category.
Okay.
That's something which we're trying to work on. So that could be new category.
Sure.
SIF is another category where we have applied for the license. So that will be a new asset class which we will create. We're trying to do some work on, we have done some work on Gift City.
Okay.
We are trying to do some incremental work on Gift City with creating international funds for diversification we spoke about.
Right.
So these are some of the 2026-27 business plan where new vehicles, new asset classes, new products for our investors.
No, absolutely. Wanted to ask something on the SIF front, but you already said that you are planning. Anything you want to add on to it that actually picking up some momentum the SIF funds, because the recent data which has come out. So a lot of flows are actually
Yes.
getting directed towards
It's
that.
Kshitij, it's a absolutely new asset class.
Sure.
It is very different. It is meaningfully different from regular mutual funds.
Yeah.
And it is in terms of regulation, it is slightly different from AIFs.
Yeah.
But the biggest advantage of SIFs is the tax structure. Now, typically, what is the differentiation in a SIF versus a regular mutual fund is that the regulator is allowing you to do a 25% naked short position.
Yeah.
Right? Now, if you do derivatives on AIFs, all the money you make on derivatives within a AIF is taxed at the full rate.
Right.
Now, if you do the same practice on a SIF platform, you're not taxed because it's a mutual fund structure.
It's a mutual fund structure.
So the leakage of return between a AIF and a SIF is a big savior, right? So what we are seeing is that a lot of complex derivative strategies, and the largest one is a long short kind of category of funds. That is the first product which everybody is doing there, because for the same efforts you can give a higher post-tax return to the investors, right? So I think it's a very interesting asset class. Using derivatives, how you can create differentiated strategies for people who are looking at arbitrage plus kind of return, or who are trying to outperform the Nifty by 1-2% by hedging your portfolio in some way. There are many ideas.
No, absolutely.
So and which is where a lot of interest, fortunately, we are seeing in the distribution community. We are seeing in the investors, from all the all of you in the media also. There is a lot of curiosity and acceptability for this kind of a product. So I think we are slightly behind schedule, but hopefully we will catch up in times to come.
Absolutely looking forward. And lastly, things which investors should not do, absolutely not do at this point in time.
Two things I would say. Don't run away from your asset allocation just because of market movements.
Okay.
Be in the game to win the game. Or as they say, that to finish first, you have to first finish.
Yes.
Right? So be in the game. Don't get confused, don't get scared, and don't leave the game and go out, right? So that's the first thing. Secondly, I would honestly request is that, especially to the mutual fund investors or PMS AIF investors, those who are investing in professional fund managers, spend a lot of time in deciding which manager you want to give money, right? But simply don't buy funds on 1 year of top class performance, because fund managers also go through cycles. So if you buy top performing funds, then in the initial period you may also go through a period of underperformance. So much rather, I would say that spend time on understanding the fund house, fund philosophy, portfolio, product, and then give that fund manager a 10-year cycle where he will go through his ups and downs, but eventually the potential to help you achieve your goal is very, very higher. But the biggest thing all of us, the entire industry, are trying to fight is that जिसका फंड अच्छा चलता है उसको बहुत सारा पैसा मिल जाता है, जिसका फंड नहीं चलता है उसका पैसा निकल जाता है, and most of the time the money is moving from here to there, to there, and उससे सबसे बड़ा नुकसान किसी का नहीं हो रहा है, but it is the investor, because वो क्या कर रहा है, completely contradictory to the principle of buy low, sell high. He is doing reverse. He is buying high and selling low, buying high, selling low. तो आपका average return is way below even the index return. So that is my humble request to all investors, that simply don't judge fund managers by their recent performances, whether good or bad. Right? Much rather try and understand their thought process. And now you have so much of information available, data, videos, fund manager interviews. तो spend time. I mean, अगर आपको कुछ महंगी चीज खरीदनी है, गाड़ी खरीदनी है, तो आप हफ्ता महीना 2-3 महीने रिसर्च करके फिर गाड़ी को हर 15 दिन में तो नहीं बेच दो, इसी अच्छी नहीं लगी तो बेच दो, right? So think that you're buying a home or you're buying an asset which you have to be married to for a long time, and then you do research, and there are umpteen resources available to get access to data. Otherwise, I would say that simply buy indices. If you have trouble trusting managers
Right.
because of their performance cycle. You have
Shift to passive investing.
shift to passive. At least
Right.
you will get the market return.
Right.
Right. So this is my biggest thing which I always talk about,
Absolutely.
and I hope it helps people really allocate well to the right managers.
And like you say, buy right, sit tight.
Yes, yes. And once you have done that,
Yeah.
you have trusted a manager
Right.
or couple of. I'm not saying one manager.
Yeah.
Have 4 or 5 managers or 6 managers. Trust them.
Mm.
Trust them for life. Then it is buy right, sit tight, and then you can sleep also tight.
Sleep also tight.
So buy right, sit tight, sleep tight.
Absolutely valuable insights coming there from Akhil. Thank you so much for taking the time out for actually demystifying a lot of scenarios for our investors. Again, thank you so much.
Thank you,
for your time.
Kshitij, and I think I enjoyed this interview. Thank you so much.
Thank you so much. Yes.